Most people think markets move because of news. A war starts, stocks fall. A company reports record profits, shares surge. Inflation rises, everything shakes. It feels logical, cause and effect. But what if that's not the real driver? What if the biggest moves in global markets happen before the story even exists? Because behind the headlines, behind the charts, behind the daily chaos, there's an invisible force quietly shaping everything. And once you see it, you can't unsee it. Right now, trillions of dollars move through global markets every single day. Stocks, bonds, currencies, commodities. To most people, it looks like a giant decentralized machine, millions of investors making independent decisions. But here's the uncomfortable part. A huge portion of that money isn't reacting to the economy, it's reacting to something else entirely. Liquidity. Not profits, not innovation, not even growth. Just liquidity, the availability of money itself. Let's simplify this. Imagine the global economy as a giant system of pipes. Money flows through banks, funds, governments, and markets like water. When there's more water in the system, everything rises. Asset prices go up, stocks feel unstoppable, risk looks safe. When the flow slows down, the opposite happens. Markets tighten, volatility spikes. Suddenly, everything feels fragile. Now here's the twist. The amount of water in the system isn't controlled by the market, it's controlled by a small group of institutions most people rarely think about: central banks. Central banks don't just set interest rates, they influence the entire flow of money. And over the past 2 decades, their role has quietly expanded from referee to dominant player. After the 2008 financial crisis, something changed. Traditional tools weren't enough. So central banks introduced a new mechanism. They started creating money at scale, not by printing physical cash, but by digitally expanding their balance sheets, buying government bonds, injecting liquidity directly into the financial system. This process has a technical name: quantitative easing. But strip away the jargon, and it's surprisingly simple. They add more water into the system, and when that happens, the effects ripple everywhere. Here's where it gets interesting. That money doesn't flow evenly. It doesn't go straight into wages or small businesses or everyday life. It flows first into financial assets. Banks receive it, institutions deploy it, funds chase returns, and suddenly asset prices start rising, not necessarily because things are better, but because there's simply more money chasing the same assets. It's like an auction where the number of bidders keeps increasing, but the number of items stays the same. Prices don't rise because the items became more valuable. They rise because competition increased. This creates a strange disconnect. Markets go up, but the real economy doesn't always follow. Stock indices hit record highs, while wages stagnate. Housing prices surge, while affordability collapses. On paper, everything looks strong. In reality, the foundation feels shaky. And yet, markets keep climbing. Why? Because liquidity hasn't stopped. But here's the uncomfortable math. This system depends on constant support, because once markets get used to easy money, removing it becomes dangerous. Think about it like this. If markets are rising because of liquidity, what happens when that liquidity is reduced? We've seen glimpses of this. In 2018, when central banks tried to pull back, markets reacted almost immediately. Volatility spiked, prices dropped, panic spread faster than expected. It didn't take a recession, it didn't take a crisis, just less liquidity, and everything started to wobble. So central banks adjusted. They stepped back in, added more support, stabilized the system. But each time this happens, something subtle changes. Markets become more dependent, less driven by fundamentals, more driven by expectations of intervention. It's no longer just about earnings or growth, it's about what central banks might do next.
And this is where the invisible power becomes clear. Markets don't just respond to actions, they respond to signals. A single sentence from a central bank official can move billions, not because anything actually changed, but because expectations shifted. It's a system built not just on money, but on belief. Now here's the irony. The more central banks try to stabilize markets, the more fragile the system can become, because stability encourages risk, and risk builds up quietly, until something breaks. Meanwhile, the public narrative stays simple. Markets are rising because the economy is strong, or falling because of uncertainty. Clean explanations, easy to understand. But beneath that story, the real driver is harder to see. A global liquidity cycle, expanding and contracting behind the scenes. And it doesn't just affect stocks, it shapes everything. Real estate bubbles, currency swings, tech booms, crypto surges, all connected by the same underlying force. When liquidity expands, risk assets thrive. When it contracts, everything gets tested. The challenge is timing, because liquidity doesn't disappear overnight. It shifts slowly, then suddenly, and by the time it becomes obvious, markets have already moved. So the next time you see headlines explaining why markets are up or down, it's worth asking a different question. Not what happened today, but what changed underneath. Was there more money flowing into the system, or less? Because in the end, the visible market, the one everyone watches, is only part of the story. The real driver is quieter, less obvious, and far more powerful. An invisible force shaping outcomes long before the headlines catch up. And if global markets are increasingly driven by liquidity instead of fundamentals, then the real question isn't where prices are going next, it's what happens when the system that's been holding everything up starts to pull back.